about what we're trying to do with the efficient frontier, right? Alright, well the efficient frontier, the idea is very simple.
As long as the risk...
The idea is very simple. If I will be assuming some risk, any risk, as long as there is even a little bit of risk, could be a lot of risk of course, what I want to do, and this is here risk, this is here return. If I will be taking any risk, if I could get 1% return out of the risk, I want to get it. But if I could get 2, I will certainly insist to get an expected return of 2 instead of 1. Well, the logic continues. If I could get 3% return instead of 2, again, for the very same risk, I will try to get 3. So, the idea of the efficient portfolio is that you try to get as much return as possible, and the efficient portfolio is this particular point here on the, or the efficient frontier is this particular point which gives you the maximum possible, attainable, expected return for one given risk. For the next given risk level, you can get, and of course it will be bigger or larger expected return, and it is higher. If this return is 11%, then this return will be, let's say, 13%. So, what the efficient frontier does is to extract as much, well, that's what diversification is. Diversification is an attempt to extract more return out of the same risk. However, there is a different way to think about it. The different way to think about it is, if I'm going to get some particular return, 10%, which is the minimum possible risk that I should assume in order to get that 10% return. Alright? So, for example, you can get that much risk, alright? Or you could move and get the same return for less risk. Or the same return for even less risk. Well, the frontier will give you, the point on the frontier will give you the guaranteed minimum risk for which you can attain this particular return. In other words, investors typically think in one of two ways. They typically think in the way, I need to get at least 10% return. Tell me what is the best investment where I can expect, of course, no one guarantees 10%, when I can expect, hopefully, in the long run, 10%. And in other words, how much should I push risk into my portfolio in order still to expect 10%? For example, retirees typically think that way. They think of that way. Oh, I don't want to lose more than 5% of my principal in my portfolio 5 years out. So, tell me, given or subject to this particular risk constraint, what is the best return that I can get? In other words, this is a basic trade-off between risk and return. Alright, this is the basic trade-off. So all of this efficient diversification, efficient portfolio, this whole story is about extracting the maximum return for a given risk, or for a given return to assume the minimum possible risk. Is this now beginning to answer? And the efficient or the frontier is a collection of all of those points, the collection of all of those points which give you these combinations. So if a point is on the efficient frontier, this simply means you cannot beat the return of that point for the same risk. Or you cannot beat the risk, meaning lower the risk for that given return. That's all it means. In other words, somehow it is human nature. It is just human nature that if I'm going to be getting 10% return, I want the minimum possible risk. People just don't want to risk the money for which they have worked hard 5, 10, 20 years, for which they have sacrificed, made tremendous sacrifices throughout their lives. They don't want to risk something which they have built and accumulated and worked for 20 or 25 or 30 years. So what they want to do is still get what they call decent return at a minimum rate. That's what all portfolio theory is about. So that's the first part. The second part is, how do we actually put stocks in there? Do we use Microsoft? Do we use Dell? Do we put in Saudi Aramco or SABIC or whichever your stocks are? So questions?
Sir, I mean the efficient frontier is an assumption, right? It's not an actual...
No, it's not an assumption. It is something which certainly exists. It is something which certainly exists. If you're going to be getting 10% or demanding 10%, we call this required rate of return. If you're going to be having a required rate of return, it will actually give you that you have to assume 30% risk or 30% volatility. In other words, within a certain period of time, of course, the volatility is always measured for one period. So, if you're getting 3 periods, you're investing in 3 periods, the volatility begins to compound. Not exactly with the same math as returns compound. Alright? In other words, if you're assuming 30% volatility in 1 year, it simply doesn't mean that for 2 years you're assuming 30 plus 30%, 60% volatility. It does not mean that. Volatility is not that additive, in that linear manner. So doubling the time does not necessarily double volatility. It is fairly straightforward time series or random walk statistical analysis that if you begin from somewhere and you have a certain trend. Of course, the trend could be 0. You're just flipping coin. The volatility is not straight lines. If the volatility was a straight line, this simply means that volatility is additive over time. It means that if in 1 year you're risking 30%, in 2 years you're going to be risking 60%, in 3 years somehow 90%, and so forth. This is not how volatility works. Volatility actually works in this way. It goes like this and then widens, but at a much lower rate, and then it goes similarly on the other side. In other words, the curves are symmetric on the upside and on the downside around the expected value, and they're not straight line, they're more like logarithm. They're logarithmic curves. In other words, as you go over time, the risk is increasing, but proportionately is increasing less. Alright? So this is the fundamental intuition that you get. Well, of course, it's fairly straightforward. You start flipping a coin, right? You expect the value to be, let's say, out of 100 flips, you expect the coin to be, let's say, 50-50. Well, of course, it could be 55, it could be 55 versus 45. Now, suppose we flip the coin 1,000 times. Of course, you will expect possibly 550 versus 450. But now, because you've increased increase 10 times, the probability of 550 versus 450 is a lot less than 55 versus 45, right? You understand this? In other words, as you increase the number of flips, the same ratio, 55 to 45, begins to go down a little bit, all right? But of course, overall, 45 to 55, the spread between the two of them is 10, all right? And then, if you have 1,000 flips, you don't expect the spread to be 10. Expect the spread to be maybe 30, okay? Maybe 30. But you don't expect it to be plus 50 and minus 50, all right? You expect it to be plus 15, minus 15, a total spread of 30. That will be the standard error, or the standard error of the distribution of the returns. Alright? So, proportionately, it will be shrinking, but in absolute value, it will continue to increase. It continues to increase for the shockingly simple reason that as more time elapses in the future, it is harder to predict. In other words, it's fairly simple matter to predict the weather and the temperature 1 minute from now. Even I can do it. It's easier to predict the weather 5 minutes from now than 5 hours from now. And it's easier to predict the weather 5 years from now than 5 days from now. And then, if the things try to predict the weather 5 years out, you say, oh no, that's impossible. It's next to impossible, all right? So, the further you go out into the future, the more uncertainties and other random factors compound, and the bigger the error is. Well, same thing here. All right? Is this clear? Now, let's see. More questions. Everything's clear? All right. Then we move on to capital asset pricing model. This will be chapter in my textbook is 7 your textbook 7.2. So portfolio theory, lecture number, which lecture is this? Number 4? Is it? 5. So, lecture 5. Then we are on the Bodie Kane textbook, Essentials of Investments, chapter 7, right? Yes. Chapter 7. And 7.1 is capital asset pricing model. So, what is the capital asset pricing model about? Capital asset pricing model is basically what we studied so far last time, and that is, it includes a number of assumptions. The big assumption is that investors are rational. Investors are rational. And the second big assumption is that the market is in equilibrium. And now we get to the argument which I made in a very short manner last time, is that if investors are rational and at the same time the market is in equilibrium, then the first thing that follows is that all stocks, this is here RF, all stocks will be on this risk is here, and return is here. So, if everyone is rational, the market is in equilibrium. If you have a stock B, it will be here. Stock or asset A, so A, B, C, D. So, if you have investable or tradable assets, they will be simply on this line. The argument is always as follows. If it happens that the stock or the asset provides what we call here above average expected return, then investors will rush because they are rational. They will see that it provides above average return. They will rush and buy it. All of them rushing to buy it will raise its price, and because the asset has some income, the future income and the future income streams, which you guys usually call cash flows, the cash flow, the stream of cash flows remains unchanged. The value remains unchanged. But if you drive up the price, it must be that the expected return will necessarily fall. So, rational investors will bid up the price of the asset and will drive it back down to that line. It has a name, right? Then the opposite argument is also true. If for any reason an asset was providing below the average expected return for its risk, then investors say, oh, it's providing not enough return, they will sell. Well, when you sell, you lower the price, but the cash flow is still remaining the same. Just buying and selling the stock does not change expected future cash flows and does not change the discounting. So all that does is the price changes, and if the price falls, the result is to drive the expected return back to the curve. So, rationality and ability of investors to evaluate essentially means that if any asset is away, whether above or below, rational investors will drive it back on this curve. So, that's number one. That's the first piece of the puzzle. The second piece of the puzzle is the so-called separation property. Separation property. So that's the one piece. Now, the separation property results in the so-called mutual, so I'm adding it here for more time, out of it flows mutual fund theorem. So, separation property is a result of a general property of constructing portfolios that you first construct the risky assets. In other words, you already construct the risky portfolio. So risky portfolio, I draw it here as probably having 10 assets or 10 stocks. So this is the risky portfolio. It is already constructed. It is also an efficient portfolio. And then you also have a risk-free portfolio. Now, the textbook usually says risk-free asset. The textbook usually says T-bills, alright? It could be, of course, T-bonds, depending on your investment horizon. So, it could be just T-bills, it could be a mixture of government T-bills with T-bonds. In other words, the risk-free portfolio could have a mixture of different maturities of government T-bills. Now, the risk-free portfolio could be a as the textbook said, at least in practice, money market mutual fund. Well, money market mutual fund will be investing typically in, remember from last time the lecture?
What's the best element?
It will be investing in commercial paper. Okay, what else?
Loans.
Huh?
CDs.
CDs, yes. So, commercial paper, CDs. Sometimes TVs. And what else?
Bank loans.
Huh?
Investment loans.
No,
Investment loans.
Repos. Repos. Of course, all of these with a maturity of 1 to 3 months, sometimes extending up to 6 months, because the very short maturity usually minimizes the interest rate risk. Interest rate risk on a 1-month asset is, for practical investing purposes, negligible, close approaching zero, okay? The interest rate risk for a 3-year asset is huge, okay? So the volatility begins to rise rapidly as the maturity expands. So, risk-free portfolio is this, risky portfolio is this, and then what separation property says, because the assumption here is no volatility, because the assumption here is no volatility, and therefore, if it has no volatility, it means it stays constant. It has no correlation with the risky portfolio. So, how you choose the risk-free and how you choose the risky portfolio, there is no correlation. This also means that there is no effective diversification effect. So, what the separation property says is that essentially you first construct the risky portfolio. It is more or less the same, and then you choose, let's say, 10% risk-free and 90% of the risky portfolio. So, the first step, you construct it, and then you choose its weighting. And the weighting will represent the risk aversion of the investor. In other words, very risk-averse investors will have a very low percentage of the risky portfolio. So, the most risk-averse investors will literally have 0% of the risky portfolio. Those that are moderately risk-averse could get anywhere between 30 or 50%. Those that are relatively risk-tolerant can easily get 70 to 90%, and some could possibly get even 100%. For example, for young people, they even suggest maybe 90 to 100%. I'm not saying that I recommend this. I'm saying this is what the industry is recommending, right? The industry is betting that most of the investors are young, so that they will be buying more stocks. At the end of the day, what Wall Street does is sell stocks. So their recommendations are always biased towards holding more stocks, okay? That's a different story. Anyway, the separation property is simply that you make a separate decision for the risky assets in the risky portfolio, a separate decision for the risk-free portfolio, and then once you've constructed these, it is a completely separate and independent of these two, the weighting. So, ideally, we will have one and the same risk portfolio, and depending on the preferences, I will choose 70, you could probably choose 90, another one will choose 10. So this is what the separation property is. Well, out of this property, in the capital asset pricing model, you get the mutual fund theorem. The mutual fund theorem simply says that you will simply have one mutual fund. That fund will consist of the market portfolio. In other words, very well diversified portfolio, and everybody will be investing between some risk-free asset and this particular market portfolio. But this market portfolio is simply held in a mutual fund. In other words, for all investors, turns out that one can construct one universal portfolio. It will be held in a mutual fund, and one mutual fund can satisfy the investment needs and provide an optimal portfolio for every single risk-averse investor. But that particular investor will choose the percentage or the weighting of that particular mutual fund, and the rest invested in bonds. Of course, they don't want you to invest in commodities and oil, right? Alright, so this is the idea of the mutual fund. Of course, if we go one step further, if this is your portfolio, you would probably have one huge, well-diversified fund of stocks and only stocks. You would have a separate, very well-diversified money market mutual funds, okay? Then you will have a fairly well-diversified real estate fund. Then you'll have a very well-diversified, let's say, commodity and commodity fund. And finally, you will have something in currencies. Now, it's a little tricky when you expect a lot of inflation. If you expect a lot of inflation, then you will get a little bit larger percentage of real estate because it is not prone to inflation. In other words, inflation does not erode the value of real estate as much as it does on money market mutual funds or on bonds. You will lower this, so you will increase real estate somewhat more. Usually stocks are very vulnerable to inflation, so you will lower the weighting of stocks. You will lower the weighting of money market mutual funds. You will increase the weighting of real estate. You will definitely increase the weighting of commodities, and you will increase the weighting in foreign currencies. Now, Peter Schiff's suggestion is, sure, you will have money market mutual funds, but in foreign currency. Alright? So, yes, you should have money market mutual funds, but certainly in foreign currency, so that you do not subject yourself to the inflation/currency risk. Alright? Because inflation risk results or causes currency risk. Now, the government inflates a lot, the result is a depreciation of the currency, so sooner or later inflation risk is transformed into currency. Similarly with stocks, he doesn't say don't invest in stocks, he doesn't say you should have a lower percentage of stock, but he should say that says that these stocks should be foreign stocks. In other words, stocks of companies which derive their revenues either in real estate, commodities, or in foreign currencies. In other words, the revenue stream of the stocks is not subject to the same currency risk, or is relatively minimized. All right? For example, Bulgarian producer of shoes will not be much subject to the US dollar risk. Shoes are shoes. Dollar may fall 3 times, or some other currency may fall 3 times. Better, the shoes will be more or less stable when measured in stable currencies. Alright, so stocks, he doesn't say, oh, you have to lower them dramatically. But he would say that you should lower them dramatically. Well, he personally said you should eliminate all stocks which depend for the majority of their revenues in the United States, all right? Both in terms of the country and in terms of dollars, all right? Because he believes there is also this type of risk associated with macroeconomic risk. So he sees the macroeconomic risk to be so large that it should be relatively, we call this underweight. Now the arrow here is called in finance underweight. And the arrow here is called overweight. To overweight means that you choose a percentage which is larger than some normal circumstances, whatever normal means. Normal sometimes would just mean average. Right, so you have normal in terms of macroeconomic circumstances and average in terms of an average investor. Alright? So, for example, young people should be, or is typically recommended to be, overweight stocks and underweight bonds. On the other hand, people very close to retirement should be relatively overweight bonds and relatively underweight stock. So I'm just trying to explain the usage. So in highly inflationary environments, you should be relatively overweight real estate and commodities and foreign currencies, and in relatively stable inflationary environment, or especially this inflationary environment, stocks and bonds typically outperform, and you should be overweight in those. Alright? So back to capital asset pricing. So what follows out of the mutual fund theorem is that everyone should hold the same portfolio. But here's the trick. I hold a percentage of some portfolio. You hold a percentage of the same portfolio. He holds a percentage of the same portfolio. So we're all holding some small percentage of the same portfolio. Well, what happens if we add all of our portfolios together? What happens?
Increase the return, increase the risk.
No, we didn't increase, we didn't lower the risk. All we're going to get, the portfolio of my stocks plus the portfolio of his stocks, the portfolio of everyone's stocks, when you add them all up, you get one thing, the market portfolio. The market portfolio. So, the sum of everyone's portfolio, when you add it all up, there's nothing else. It is the market portfolio. It's simply how it is. In other words, the definition of market portfolio is simply all stocks on the stock market, or all assets on all asset market, okay, on the investment market. So, we have my stock, your stock, his stocks, everybody's stocks, all you get is the stock market. So, the idea is, I'm holding this mutual fund, he's holding it, everyone is holding optimally the same mutual fund. Then, when you add all holdings, the mutual fund itself must necessarily be the market portfolio. So, what capital asset pricing model concludes is very simple. Everyone will be holding, based on the mutual fund theorem, everyone will be holding the market portfolio, number one, and will be holding risk-free assets, and people will simply fine-tune or choose the weighting according to them. That's number one. Number two is, and let me try to draw this here. Now let's draw this here. is that if you have the efficient frontier, whatever the efficient frontier is, the next result is that everyone, remember, will be trying to maximize. So the next result is actually that everyone will be holding the best possible portfolio here, right? And we'll be holding the risk-free. Let's draw it now with a blue line. So I'm going to be using a blue line here that just touches it. So what capital asset pricing model simply says, oh, everyone's going to be holding the optimal portfolio because this is the optimal portfolio, and everyone will be just keeping ratios, certain weightings. It must be that this itself is the market portfolio. Alright? So, it is based on the mutual fund theorem. It is based that everyone is keeping an efficient portfolio, but everyone's keeping also the same portfolio. It must be that on the efficient frontier, this particular point is exactly the market portfolio. It's just derived by logic. Alright? Is this clear so far? Alright, so now let's move on to just provide you with the core. Now let's provide the basic assumptions. Now the way I went is a little bit backward. I kind of gave you some of the logic. I kind of gave you some of the conclusions. Now let's get the assumptions. So what are the basic assumptions? The first assumption, which for me is number 3, because I've already used that 2, is that investors are price takers. So the assumption is called the price taking assumption. Price taking assumption means that all investors are relatively small and their buying or selling of that particular asset does not affect the market price. Of course, individual investors are, in reality, indeed price takers for the most part, but major mutual funds are certainly not price takers. Now, when you take very illiquid stocks, I mean, you have, let's say, mining stocks, gold mining stocks, silver mining stocks, or gold exploration stocks, silver exploration stocks, or some very small energy companies that are dealing with something they're very illiquid. Maybe they trade 20,000 shares a day. Maybe they trade 50,000 shares in one day. Maybe the price they are called penny stock. You guys know what's a penny stock?
Cheap stock.
Doesn't mean, what does it mean cheap? Cheap stock for different people mean a lot of different things. Penny stocks usually means that the price is typically less than $1. In other words, the price is quoted in pennies. So it's 53. Of course, penny, that's coming from back, British English, where, penny is the equivalent of a cent, alright? So, essentially, penny stock means that the price is less than $1. So, penny stocks will be maybe 50 cents, maybe 20 cents. So, the overall volume of $20,000 may be literally $10,000. You want to try today to buy, let's say, $5,000, invest into this particular stock. Your own buying will certainly move and drive the price up. Alright, it's as simple as that. Or your own selling, especially if you've accumulated stocks over a period of time. When you try to sell, you can suppress the price. Well, the assumption is that nobody is able or capable of suppressing the price. And no one's trading affects the market. A different way of saying is that the market is, this is the same as saying that the market is liquid. Liquid means that a large amount of buying or a large amount of selling will affect very little the overall price. Alright? So, what's next? Number 2. All investors, in my case it is number 4, have identical holding period. Identical holding period. So, when I'm investing with a holding period of 2 years. You're also investing with a holding period of 2 years, and everyone is investing with a holding period of 2 years. Now, holding period is known in investments, and I don't know why they didn't use it. We have a special term, and everyone calls it that way. We call it, anybody?
Period.
Investment horizon. Investment Let me wipe this off so I can get a little bit of space. If I need, I will redraw. Investment horizon. And of course, we can say constant investment horizon or identical investment horizon. In other words, everyone's investment horizon is the same. What's next? There is what's called, or investors form their portfolio from a universal, how do they call them? That's variable. Publicly traded assets. Alright, so everyone's choosing the same universe of publicly traded assets.
Stocks and bonds.
This is the assumption. Nobody said stocks, we just said assets. Otherwise, we would have said stock and bonds. Alright? We just said assets. Real estate, oil, alright? Is oil publicly traded?
The stocks are.
Well, what about oil?
I think
Is oil publicly traded?
No, it's not.
Of course, it is publicly traded. Sure, it's publicly traded. You got a whole bunch of exchanges all around the world trading oil, trading different types of oil, right? Brent oil, light sweet, crude, of course. I'm just testing you guys. Alright, so let's see what the next assumption is. Investor pay neither taxes nor transaction costs. So, no taxes. 7. No transaction costs. So these are all assumptions. What else? The next one is everyone is constructing efficient portfolios. So everybody makes efficient portfolios, which also implies that everyone is at the same time rational. Next one. Investors analyze securities in the same way. So, same investment tools, the same investment analysis, and this also applies identical investment approaches. And of course the same investment evaluation. homogeneous expectations. Everyone has the same expectations about the asset. Alright? So, these are the assumptions. Let's see how good they are. Let's see how good they are. Number one, the same as rationality. Okay, so investment tool and whatnot. So, this one. Is everyone constructing in the real world efficient portfolios? No. Number one, 99.9% of all investors in the world have no clue what is an efficient portfolio. 99.99% of people have no idea, even if they knew what it is, have no idea how to construct it. Alright? I have no idea how to construct it. I've never constructed myself. I'm not even bothering to construct. I see what's good to invest in, and I invest in it. I think oil is a great investment now, especially at 60 bucks. I invest in what? I think gold is dirt cheap. I invest in gold. I need for my retirement to have me a nice place somewhere in a resort, meaning like real estate in a resort, in a Bulgaria resort area. I think it's going to cost me between 20 and 30,000 euro, let's say $30,000, $40,000. I don't give a damn about efficiency. I'm going to go and buy one because I think I will need one, because I expect I'll retire one day, and I will retire at a place which is has relatively clean air, has nice quiet life, has relatively low crime, and all the other good things about a place you want to retire. And I don't give a damn about efficient portfolios. So when I'm constructing my own, I don't care about efficiency. And 99.9% of all investors don't know what it is and don't care. So we get on this one efficiency and we provide one big red no. Alright. So, buy a house cost me in the United States about $3,000 I paid to the broker to buy me a house, to broker me the purchase of a house in 2000, when I bought the house in 2000. Now, when I was selling it, I chose actually to get a better broker, a better salesman. So he actually charged me a little higher percentage rather than 5.5%. He actually charged me 6.5%. And my house had appreciated a little, well, a lot in that 2000 by 2004. So I actually paid $5,000 in commission. All right? Of course, every time you buy a stock, you pay, I don't know, $10, $20, $30 commission, depending on your broker. Everybody says stock. So, when it comes to transaction costs could be a very significant. They always exist. There is always some. And most of the times, they're very significant, especially if you're going to be investing more or less actively. Even if you are just giving your money to a money manager, the money manager will charge you a transaction cost. Of course, they call it just a management fee of 1 to 2%. If you're investing in a hedge fund, they can easily take 20% of your profit. So, the transaction cost is certainly not satisfied in the real world. No taxes, alright? Well, of course, maybe in Saudi Arabia, investors don't pay any taxes on their profits. In Bulgaria, they may not pay taxes on their dividends. But overall, when you are running investment, what we call profits, in other words, in most of the civilized worlds, you get taxed on your investment returns. Alright? That's how it works. Practically every country in Europe will be taxing investment returns, whether they're capital gains or dividends. Alright? So, usually taxes where you have no tax taxes on investments is extremely rare. For the most part, this is not satisfied. Now, the real big one is actually universally publicly traded assets. Well, 90% of all assets are actually not traded and certainly not publicly traded. Most of real estate investment is not really traded and certainly not publicly traded. Just don't have pieces of land just publicly. Every now and then, maybe 30 or 50 years, an asset will be publicly traded. Alright, so this is definitely not true. A net holding period, of course, is a total joke. You got traders, day traders, that have only 1 hour holding period. That's what they expect, between 1 and 2 hours. You have scalpers, and their average holding period is 1-2 minutes. You have some younger guys that may have a holding period of 20 years. You have some retirees that will be soon dying, and the holding period is 1 or 2 years, right? After they die, the portfolio gets liquidated, and all the grandsons will just go on vacation with the pork money, right? So the point is, different people have different investment horizons. Then again, some investors invest in they hold it for a while, hoping to hold it for the rest of their lives, and 2 years later they see, oh, geez, the stock is not doing well, they read a bad news about a company, they just sell it. So, investment horizons usually last anywhere from a couple of minutes to a couple of years, and sometimes to a couple of decades. So, investment horizons are certainly not identical. They vary widely. Same investment tools. Hell no. You have 1,000 people, they'll tell you 1,000 different ways of how to value stocks. Some are technicians and they say only technical analysis works. Others are fundamentalists, says technical analysis is garbage. They're just sending you research. Some, when it comes to investment approaches, Warren Buffett's got one approach, George Soros got a second approach, I got a third approach, same story. 100 investors will tell you 100 different approaches. You may have 1,000 people swearing that real estate is the best investment in the world. Then have 1 million people swearing that stocks are the best investment in the world. Another million people will swear that bonds are the safest investment in the world. Another million will say, no. Bonds are extremely risky, especially in a rising interest rate environment, certainly, and especially in inflation. In other words, people see the world, 1,000 people see the world in 2,000 different ways. So this goes all the way from the beginning to the end? No. So certainly investors are not rational. That one is clear. They lack all the tools and everything necessary to be rational. And finally, so this rational is no. Equilibrium. Isn't this market in equilibrium most of the time, some of the times? The answer is certainly no. If the market was in equilibrium, you will never experience large volatility, and you will never experience stock market crashes. Of course, if market was in equilibrium and markets were rational, it will never ever get real estate bubbles, but we sure get them all the time, right? So this is definitely not true, and for every significant or major mutual funds are not price takers. They can move the stock big time up or big time down, and even for small stocks, a small investor could move the stock easily. I mean, I was investing my own portfolio back in the old days in 2000. I had like $20,000 when I tried to buy a stock called back then, and now SSRI, Silver Standard Resources. The stock was so illiquid and so small, I had to buy 500 shares now, wait a couple hours, see an extra bid, buy 500 again. Now, I just couldn't just buy a lot of shares, couldn't just buy 5,000 shares. There was no 5,000 share bid. You know? So the bids were like 200 shares. So I gotta, slowly but steadily. And if you're a mutual fund trying to accumulate, then it becomes a nightmare. You have to accumulate for months so that you don't drive up your own price to yourself, because your own buying will affect your own price. It can drive easily. You try to accumulate a little bit with stock, the price is fine. You can easily drive it just yourself within a matter of 3 days up to 10 or up to 15. Of course, you don't want to drive up your own price. So what you do is you buy a little and buy slow. But the point is, it says, oh no, the market is always liquid. And everyone's a price taker, and this is a big no. And number 9 is a big no. And then the question is, why the hell do we even study it if everything is dead wrong? And, well, what's the answer?
We have to.
Yeah, we have to. Well, why?
Wall Street.
Wall Street is one thing. Actually, Wall Street is a little bit tricky. It's a different reason. No. Capital asset pricing model uses regressions.
Best line.
Regressions.
Best fit line.
Best fit line regression. What does regression have to do with having to study it? Capital asset pricing model is the perfect model for professors to run regressions, do research, and publish articles. It's all about the ability to publish articles. So you get one more factor affecting returns or market return or whatever. You run one more regression, you make one more conclusion, and you publish an article. Then the next guy comes and says, oh, but this is for the US. For Brazil, we run it and we see the result is different. Then someone will come back and say, oh, well, but this is different. If you get to use all of Europe, you get a third result. And everyone publishes every single step of the way. Then some say, oh, but this is using this type of inflation adjustment. If you use a different type of inflation adjustment, result is different. One more published article. Then somebody else says, oh, but they use the database from 82 to 2000, but if you use it from 70, then their results are not valid. One more published articles. In other words, tens of thousands of articles are published on capital asset pricing model. You can get a student, he gets another idea or a different data set, like Saudi data set, and then we call it you milk the data. You know what's to milk the data? You run a whole bunch of things, see something comes up, which is different from what already others have done, and if it's different, you write it up nicely, and you get a nice paper. Everything's about paper. Paper as in you publish an article in journals. So, usually, especially when it comes to capital asset pricing model, you have thousands and thousands and thousands of articles, and professors love it because they can publish with it and they can specialize in it. And nobody gives a damn about these. It's important just to crack yet one more regression and publish one more article. Is this good enough? So now you know everything you need to know about capital